we had fixed rates at like 1.5-ish, and now we're at 2.5. It's gone up by 1%. But before COVID, we had fixed rates in the 3.5, 359, 369. There's a lot of talk in the media about the prime rate increasing 8 times. That would stall the economy, and then we'd be back to where we were during COVID, which then means rates come back down, right?
Hey, it's Alex Yao with Remax Select Properties.
And Chris Cornborough from Forefront Mortgages.
And it's your market update for November 2021. So overall, the last month has been very similar to the previous couple of months. It's been pretty steady. Numbers-wise, it hasn't really gone up or gone down much. Overall, in all of Greater Vancouver, it's gone up slightly. But that's mostly due to the homes kind of on the outskirts of Metro Vancouver. Inside Metro Vancouver, we're actually seeing the townhouses are holding tight, up slightly 0.3%, both Vancouver West and Vancouver East. But overall, houses and condos, they're fluctuating a little bit. I mean, right now it's very similar to last month, so we're not going to go too much in detail. What I really want to talk about, though, is the interest rates. Everyone's talking about that these days.
Everyone is exciting times now.
Yeah, so I think, from my perspective, from a real estate agent's perspective, the interest rates affect the market more so than the regular ups and downs of supply and demand, or any of the taxes that the government's trying to impose. Interest rates are actually obviously the primary role, and I wanted to kind of dwell into a little bit about why and what the effects are.
Yeah, well, I mean, we're emerging from COVID, arguably. The government's been pretty vocal, as are the financial markets, that the time has come to start raising prime rate. Prime rate right now is 2.45. It was 3.95 before COVID, so they've dropped it by a significant amount. And, the fear of inflation, you try to buy something at the store, half the time it's sold out. Like, there are outside pressures and constraints right now with the economy that I think are causing things to go up, like gas, food. The price of most things has gone up.
Right.
And that might not be really to do with the market being, or the economy, I should say, being operating at full capacity, because it's not. We're still well below capacity. Even before COVID, we're I think at 70% capacity. But what's happening is you've got a supply issue, and so prices are going up, supply demand. What we're going to see, I think, in the next probably 2 or 3 months is we're going to see probably an increase in prime rate. It could happen in the spring of 2022. That takes prime rate from 2.45 to 2.7 if it goes up by 0.25%. If my coffee's kicked in and my math is accurate. And what that will do is that will increase the cost of borrowing for people with variable rates, secured credit lines. We have seen also fixed rates move up from the lows during COVID was kind of like the spring of last year. We had fixed rates at like 1.5-ish, and now we're at 2.5. It's gone up by 1%. But before COVID, we had fixed rates in the 3.5, 359, 369. So we're still well below what the rates were kind of before this fiasco happened 2 years ago. And it's probably, I don't want to say it's good, because the cheaper you can borrow money at, the better. But it's probably good to balance things out a bit more, because cheap money leads to inflation and also leads to inflation in housing. I mean, people can say, well, my cost of borrowing is, a couple $100 less than what it was before COVID. I'm going to go spend a bit more. And that's kind of the mentality, I think, of a lot of folks, especially first-time home buyers, where, it's more, I would say they don't care about the price. It's more about the payments. It's a payment-driven decision sometimes to buy a house versus a price decision. And so what this will probably do is it will make people think more logically about, am I going to overextend myself? What if rates do go up? There's a lot of talk in the media about the prime rate increasing 8 times in the next year, which I don't think is going to happen. That would stall the economy, and then we'd be back to where we were during COVID, which then means rates come back down, right? There's only so many rate hikes you can put into the economy before people stop spending. And every dollar that someone pays in interest is $1 less they can spend going to a restaurant or buying clothes or a car. So there is a balancing act right now, and the Bank of Canada, unfortunately, they're on a tightrope, because if you raise rates too quick, then you stall the recovery, and then you don't have any tools left in your toolbox to really help out, because rates are already low. You can't lower them down from where they probably are right now, right? So I think it's going to be a gradual and slow increase in rates. It might be 0.5% next year. It might be 1% in the next 18 months. No one obviously knows for certain, but it's not going to be, you're going to wake up one morning and the interest rates have gone up by 0.5%. That's happened once in the 90s, and that was with the tech bubble. We're going to see rates move 0.25% at a time over a very long period of time. The government is going to take a long and methodical approach to raising interest rates because, as you say, for every 0.25% or 0.5% on $1 million mortgage, that's $400 or $500 extra interest that you're going to have to pay. And again, that's going to be taken from the pocketbooks of the consumer and put into a bank, right?
Yeah. So on that note, I mean, that kind of links back to kind of what I was saying about interest rate being the main factor of the market.
Yep.
Essentially, like you said, if it goes up 0.5%, 1%, that's on $1 million purchase on a conventional 20% down loan. That would be, approximately $400 or $500 a month.
Yep,
and over time, a 25-year amortization period, that could add up to, making the purchase $150,000 more expensive.
Correct. Yeah, your cost of borrowing is going to be factored in.
Once you budget that in, once a consumer budgets that in, that's a lot of money.
Absolutely.
Right? And once you budget that in, obviously they're going to be paying a little lower. They want to pay a little lower for the same property. And so the sellers are getting a little less. And so prices kind of come down a little bit. But however, at the end of the day, the medium between that buyer and seller, the buyer's still going to be paying more than today. The seller's going to be getting less than today. That interest goes to the lenders. I think just like gas. Remember when it used to be, I don't even know when
gas
was like $1 or something.
I don't want to age myself, but gas was like $49.9 forever as a kid.
Oh, I know. Actually, the lowest ever. I remember lining up my 1990 Oldsmobile.
Yeah, of course.
Lining up at the gas station for 39 cents a liter. But again, once you get to a certain point, you get used to it. Just like mortgage rates, once you get to 1.7, we've hit almost $2 at one point, right?
Yeah, absolutely.
And now it's kind of coming back down to 1.6-ish, 1.55, and people are thinking it's cheap.
Yeah, absolutely.
But if you think about it from 10 years ago, it's super expensive. So
and I mean rates right now, I mean they're still very low. You talk to our parents' generation when they were paying 18%. I mean, we're still, you can get a 5-year fixed rate with some lenders at 2.29. Still a screaming deal.
Exactly.
Come on, I mean it's under 4%. And I think what will happen is, sometime next year we'll kind of balance out, and I think rates will plateau, and then we should be. I think that'll be kind of it. I think we're probably at some sort of like normalized interest rate environment. Given the amount of debt that's out there, the government's got to borrow all this money, so they have to pay it back with interest as well. So they sort of like, if they raise rates on their self, that doesn't do anybody any good either, right? So there are some arguments, and I think a lot of people will just go variable rates because you can get a variable rate at 1.3, 1.4%. They'll just pay more minimum monthly and go from there. There's lots of ways to kind of navigate through rising fixed rates. Right.
So knowing that, I think if you're looking at purchasing in the next little while, it would be a great idea to get a pre-approval to lock down your rate for the next 3 to 4 months.
You can do a 120-day rate guarantee.
Exactly.
Pretty easy to do.
It
doesn't take a whole lot of information.
And it's free. Essentially, it's just lock it down, and then at least you have the option. Or if it's about time to refinance, it's a great time to do so. And I think just take advantage of what we have right now.
Totally.
Although next year it will still be low in the grand scheme of things. It's not as low as today. So
and we're in that period where it's like artificially low. Like these are weird, interesting one-off times. Probably once in a lifetime, right? That's going to happen. So.
Okay, so that's it for today. If you have any questions, email me, email Chris. I would be happy to help. So have a great day. Thank you, Chris.
Thanks, Alex.